welcome back to another episode of the Kansas City Commercial Real Estate Market Pulse. I'm joined today by Nick Morales and Nathan Roberts. Nathan, how you doing today, man?
I'm doing great, man. I'm very excited for this podcast episode and ready to hear what new information I can learn from you both.
Yeah, you bet. Absolutely. We got a fun one today. Lots and lots of good information to be shared. Nick, how are you, bud?
I'm doing well, man.
Awesome.
Excited to be here again, as always.
Absolutely. Well, thank you too for joining us. We are doing this on a regular basis for a number of reasons. Our number one reason is to deliver valuable, up-to-date information on commercial real estate. That market on Kansas City, including current listings, market trends, what's going on in the markets that we're serving, so you can make better investment and real estate decisions. The only way that I have learned to do this is two ways. One, read a ton of information, but a lot of that is prognostications on what's going to happen in the future. The other part is talking with real estate practitioners on a regular basis. And I think that's extremely important because that is where you're going to find the information that allows you to be looking through the windshield and not the rear view mirror. So I'm excited to have this conversation, especially as what I'll call dynamic the commercial real estate market has been over the past 36 to 48 months. It is important to stay in the know in what's going on. So that's our aim here at Exchange Commercial Real Estate with the Market Pulse. And we're going to do just that today. There is a lot of information because we are coming up on likely one of the most anticipated Federal Reserve meetings of late history, right? I mean, there's a lot of people watching to see what happens in the Fed. Not only that, it's an election year. Not only that, we have geopolitical risks going on all over the world. And so it's just a lot of complex scenarios to try to navigate. And so what we're doing here today is going to break some of that down and talk about how that impacts our clients and how we are advising our clients. Here's our team. My name is Logan Freeman, managing broker, founding member of Exchange Commercial Real Estate. There's some more of our team members. Katie Cobb, who really helps put all this information together on a regular basis. We've got our multifamily brokers there with Micah and Max. Nick Morales, he is with us here today, and so is Nathan. And so Nick is an expert in regards to working with business owners and figuring out, hey, is it a good time to evaluate my lease? Should I purchase the building that I'm in? What do I need to do from an expansion standpoint? And Nathan does a lot of the same on the retail and industrial side and a little bit of office as well. So thanks again, guys, for joining here today. What I want to cover first off is commercial real estate deal flow, which is starting to show signs of revival. Numbers always tell the story. As the third quarter of 2024 unfolds, the figures are beginning to shift the perception of future deal flow towards cautious optimism. That's a term that we hear a lot, right, guys? Is I'm cautiously optimistic. And I think that's well put. It's becoming an overused term similar to what we heard during the COVID years of transitory, right? Everybody remember transitory inflation? I know you guys do.
Oh, yeah.
But through June of this year, total property sales were around $211 billion. And that's across 5 key sectors: office, industrial, retail, and multifamily. And you throw a little hospitality in there. That's a 4% decline from the previous year. So overall transaction activity shows early signs of regaining its footing. Because the 2023 turbulence, it was driven by soaring interest rates in the third quarter and deepening recession fears in the fourth. It cast a long shadow over the commercial real estate market. Many sellers were wary of economic uncertainty. They hesitated to test the waters. They held back assets that might have otherwise hit the market. And as a result, transaction volume remained flat and bypassing its usual year-end surge. But as 2024 progresses, the tide does seem to be turning. the first quarter of 2024, which was still reeling from 2023's challenges, saw just $94 billion in deals. That's a 17% drop from the same time in 2023. But the second quarter brought a renewed sense of optimism with around $117 billion in properties changing hands. That's a 9% increase from the year before. And that cautious optimism extends beyond the recent uptick in sales. So the market is now watching closely for a potential interest rate cut by the Federal Reserve here in September. And that move could align perfectly with the fall selling season, right? I mean, if we think about finishing Q3 strong and going into Q4, it could really be a big surge for the commercial real estate market. And we've seen here in our markets a new investment opportunities starting to flood the market after Labor Day, right? Kids are back to school and people are getting back into business, wanting to finish the year strong. And you add in the prospect of lower borrowing costs, and that could be the spark needed to accelerate the deal flow that we've been waiting for. So anyways, all of that to be said, I want to end this slide with this fact. So if we take a broader perspective and compare current sales figures to pre-pandemic 5-year averages as a clearer momentum, the first quarter of 2024 reached just 75% of the 5-year average for the previous first quarters. But by second quarter, that figure had climbed to 84%. So that upward trajectory is suggesting that the market is regaining its previous rhythm with each quarter building upon each other. So Nick, I want to pass it over to you here in regards to conversations that you're having with investors in the marketplace. Are you starting to see and hear a sentiment change of people starting to get a little bit more optimistic?
Yes. And all the factors that you mentioned before, the election year and rates increasing, all of that was the main topic for months and months. That is now slowing, in my opinion, as far as the conversations that are being had with the people that you mentioned. Especially on the investor side where, they're becoming more optimistic because of the potential of rates declining. Then as we're seeing the asking prices starting to settle, it's very optimistic out there. And people are, I won't say chomping at the bit, but they're very eager to disperse money, which is it's an anomaly of sorts. So it'll be an interesting next couple of months to see what the Feds actually do and how people internalize that and, make that into their plan moving forward over the next, call it 6 months to a year. So it'll be interesting.
Absolutely. Nathan, how about you, man? You're out there having conversations with property owners, with investors every single day. What changes have you seen since the beginning of this year?
Yeah, I mean, I'll talk mostly about like what I've been seeing on the market. I mean, recently, all the things that's been hitting the market, I would say probably within the past 3 months have pretty much sat on the market. I think obviously it's because there's pretty much an ass big difference there, but I think that difference is going to start to get smaller as the interest rates start to creep down.
Yeah, and anecdotally, I've had some conversations with some lenders who were previously, out of the market, and it does seem that they are looking to enter back into lending, and that's gonna be a big component of finishing this year strong. And I think that is one thing that a lot of people have been waiting on. Let's look at property sales that are picking up in the core markets, right? So Kansas City being more of a second tier market compared to some of these that you might see New York and Los Angeles and DFW, Atlanta and Chicago. But core markets like those are already outpacing their prior 2-year averages for property sales. And I think that's signaling that transaction volumes may have found their bottom. In other major markets such as Denver and Miami, Minneapolis, Orange County, San Diego, and San Jose, transaction volumes are hovering around their 2-year averages, which is a stabilization sign. And that could herald a broader market activity, right? So as 2024 enters into its final stretch, the focus remains on the Federal Reserve and the potential for interest rate cuts. And I think if this current trend holds with third quarter volumes surpassing those of second, the market could be on a brink of resurgence. And the recent slump in transaction volumes could soon be a thing of the past as commercial real estate sector is starting to regain momentum and deal flow, even as uncertainty, like Nathan mentioned, around pricing persists. So it's an interesting theme to start to see these core markets, because not only are the core markets driving more activity in a second tier markets like Kansas City, we're starting to see big institutional players who have been on the sidelines for a long time enter back into the market. We're talking Blackstone, KKR, a lot of these bigger groups, and seeing some really large transactions happen on the multifamily and other asset class side. So I think that's going to really start to trickle down into the markets that we play in here, and we are watching that diligently. All right, Nathan, we're going to be talking a little bit about retail, because second quarter leasing activity jumps to the highest level in over 2 years. I mean, retailers really did shake off numerous economic headwinds and signed leases for slightly more than 52 million square feet during the second quarter. That's an increase of more than 10% compared to the leasing averages recorded over the past 2 years for that quarter. And most retail space leased in a 3-month span after the first quarter of 2022. So it's a really interesting trend to see on the retailer side. Tell us a little bit about what you're seeing out in the retail market. And man, why is retail have this big resurgence? I really thought that e-commerce was supposed to crush retail, and it was gonna really take brick and sticks out of the equation.
Yeah. I would say with me on the personal side, in the businesses I've been working with, it's a lot of service-oriented businesses that even during COVID, they were in high demand, but it just wasn't that we can have large groups or gatherings of people. Definitely with the entertainment side, I mean, you're definitely seeing a surge in entertainment, because everybody wants to get back out there and have been out there in the past couple of years. But you're starting to see more pickleball. You're starting to see more like entertainment districts come about. And even with, like I said, the service businesses, there's just been more new service businesses being started up recently. And that's why there's such a disconnect with what the demand is and the amount of supply that's out there. So even when something comes on market, like you said, I mean, it's getting leased up fairly fast.
Yeah, and the data doesn't lie here, and I think it's expected to increase even further. I mean, the nature of lease data collection is such that upwards of 30% of total leasing activity signed during the quarter isn't recorded until after the quarter ends. So 30% of the total leasing activity signed during the current quarter that we are in isn't recorded until after the quarter ends. So the data that we're reporting on could be 30% lower than what it actually is. And so CoStar is estimating that additional leasing activity is likely to be recorded, right? And including this estimate, retail leasing activity for this quarter is anticipated to eclipse 73 million square feet for just the third time in the past 5 years. You know, there's been a lot of talk about neighborhood retail shopping centers. And this talk started to happen about 18 months ago, when I started to see the Wall Street Journal writing articles about the next darling of the commercial real estate industry being retail shopping centers. And I attribute that to a couple different things. Yes, the increased activity of new concepts, like you mentioned, Nathan, but also a massive supply demand imbalance, right? If you are going out and developing, you typically haven't been developing neighborhood retail shopping centers for a couple different reasons. One, you may have wanted to do more residential. And number two, in and around neighborhoods where a lot of people like to have their shopping centers, there is no land for that shopping center to be developed. Now, what I have been tracking on the land side is very interesting, because on the urban, so this would be urban land around large metropolitan statistical areas, the amount that has been growing is about 1 million acres per year, meaning we continue to grow outside of our urban cores into suburban markets. And that is going to create opportunities for neighborhood retail shopping centers to be developed right around those areas. And however, it's just not caught up with where the demand has been. And so you can't just, snap your fingers and have a new shopping center developed, nor has it been really easy from a construction and labor standpoint to make those deals pencil. So what we typically see is a lot of those residential developments being brought to market, and then the retail developers coming in and saying, okay, now that we know these plans are approved, construction has started, let's start to find some land to start to develop these shopping centers. Here's another really cool graph and chart that I really thought was interesting that highlights that second quarter leasing activity has jumped to the highest level in over 2 years. A couple points I wanted to make here. Orange County, California, they posted the biggest decline in leasing activity as a percentage of total inventory, moving from nearly 2.7% over the past years to slightly just above more than 2% over the other years. Other markets that have seen a meaningful downward shift is Columbus, Ohio, Portland, Oregon. Those have both seen the share of inventory leased drop by 30 basis points. On the other end of the spectrum, this is kind of interesting, Washington, D.C., they saw the largest increase in retail leasing activity over the past year. What else is going on in Washington, D.C. this year, guys?
I haven't heard of much.
Yeah, right? Pretty interesting, right? So supply and demand. Minneapolis, Kansas City, and Seattle also increased retail leasing activity during the quarter. So on an absolute basis, the top 5 United States markets for percentage of inventory leased include Seattle, Miami, Dallas, Kansas City, and Philadelphia. Nathan, why a little city here in the middle of the United States? Why is it jumping up here in the top 5? And we're in the likes of Seattle's and Miami's and Dallas, Fort Worth. What's going on in Kansas City, and why are we driving so much retail leasing activity, man? That's just baffling me. It's great. Don't get me wrong. Like, it's exciting and it's very interesting, but to see where Kansas City is with those top 5, it's just pretty mind blowing.
I would say for 2 reasons. I mean, one of the things we hinted on earlier is just the amount of inventory that we actually have out there. It's not even comparable to some of these other markets. Obviously not Orange County or anything like that. Another thing would be like just the fact that we're centrally located. I mean, a lot of people are wanting to have retail brick and mortar like here in central United States. Now, are people traveling a couple hours outside of the metro to come to Kansas City to shop? No. But just knowing that our metro is spreading out, like you said, I mean, people are coming from further distances to go to the urban core to shop at places like the plaza or town center areas like that.
Yeah.
Even going as far west to go to Legends Outlet Mall. People are going there to shop. So
I think it can be attributed, and Nick, you keep me honest here, but I think it can also be attributed to population growth and job growth, right? I think those are 2 things paired alongside affordability that is really driving the retail activity here, right? Lots of new suburban developments happening. That is getting retailers excited. And also, I think that, yes, you need to have an e-commerce platform. A lot of retailers have their multimodal platforms now, buy online, pick up in store, all those different components. But I think job growth, population growth, and affordability are really on the front and center for me here. What do you think, Nick? Why Kansas City up here with Philadelphia, Minneapolis, Seattle, Dallas, Fort Worth? Man, it's those are some good ranks to be a part of.
Well, it's just everything you said with the job growth that obviously fuels the development on the residential side, whether it be multifamily or single family homes, and then the neighborhood retail. And without going down the rabbit hole of everything tied to the neighborhood retail versus big box, all of those are factors that contribute to the growth and the expansion of the city as a whole. So it's all tied together, obviously, but I would say that's directly correlated to all of it.
And if you're interested in learning more about why the job growth in Kansas City has been so strong, please go see our last episode, Volume 4, where we dive into all of the new developments in Kansas City, what's driving the new job growth, which is driving population growth in specific areas. Or you can reach out to myself, Nick, or Nathan, as we covered that in depth in the last episode. But all of these episodes are recorded, and you can find all of those on our YouTube channel as well. Now, here's one that was really interesting to me. CoStar did a really cool report. Now, these are not two markets that I really operate in, right? Hospitality and office. But check this out. In recent years, the office leasing landscape has experienced significant transformations. That's what we'll call it, right? Due to the increasing prevalence of remote work and the changing transformation of traditional office spaces. But a comparison of 5-year periods from 2015 to 2019 and 2020 to the second quarter of 2024 revealed that average quarterly office leasing volume had declined 27% on an aggregated average of all U.S. metropolitan cities. Now, here's what's really interesting. This shift has also impacted the hotel industry's performance in the last few years. So when you compare the top 25 United States hotel markets, which is tracked by CoStar, to their respective leasing volume changes over a 10-year period, it's apparent that the decline in office leasing has historically had an impact on hotel occupancy. You know, there are some exceptions, right? Las Vegas, which is an entertainment-driven destination that hosts lower office space than other top 25 markets. But the metrics did diverge in 2022. So if you look at this chart in 2022, when travel surged and office leasing eroded from 2021 levels, that's where there was a large divergence going on. And we all understand why. But were you guys aware that office and hotel were so intertwined and had a symbiotic relationship? Nathan, I'll pass that over to you because you do operate in the office sector and doing some office transactions.
No, I wasn't aware that there was somewhat of a direct correlation as it appears here. But it kind of makes sense. I mean, as we know what happened in 2020 with the whole COVID situation, and you couldn't be in groups of more than like 5 people. People were at home. People weren't traveling for business reasons or to go to conferences and things like that. But I do think when some of those COVID restrictions got released, then that's when people actually started traveling, both for personal and for business reasons. And I think that was also around the same time that a lot of corporations started requiring some of the employees to at least come to the office a few days a week for some sort of hybrid work model.
Yeah, it was just a really interesting correlation for me. I hadn't put 2 and 2 together, but like you said, it makes a lot of sense because, you know, a lot of business travel that drives the hotel industry, right? And so, you know, I have a couple of hotels in short-term rentals in the portfolio, and we definitely saw a drastic shift during that period of time because we're not a destination city, right? Really, unless Taylor Swift or the Chiefs are playing, then we are definitely a destination city. Outside of that, yeah, it definitely impacted the hotel occupancies. So something to keep your eyes on if you're in the office sector or in the hospitality sector. Definitely a cool trajectory to keep your eye on and make sure you're taking a look at. Guys, Jerome Powell was dovish in his Jackson Hole speech a week ago. He didn't hedge. He didn't push back against market expectations of several rate cuts ahead as we anticipated he might. He wasn't more dovish than the market, but he didn't offer or utter any hawkish views whatsoever to alter the market's dovish expectations for several rate cuts. He unambiguously declared that the Fed is now on course to lower interest rates. He said the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risk. So the only ambiguity that we have currently is about coming rates, is about how many, and how much, right? So this was huge for the commercial real estate market and for sentiment with investors. It impacts everything. You know, it impacts the investor psychology, which Howard Marks talks in depth about in his book, Mastering the Market Cycle. And it's very important that this is a pendulum, right? I mean, if you think about how fast rates were increased, it is difficult to put a time on how that impacts the market. It could be 6 months. It could be 9 months, right? And so the actual tangible effects of this is not that much meaningfully from a rate standpoint, right? I mean, we're talking maybe 50 basis point decline. But what is really important is the sentiment that this drives throughout these markets. So tell me a little bit about what you guys are thinking in regards to how this is going to impact the rest of the market here in commercial real estate for 2024. Nick, what did you, were you surprised by what he said, and or what are people saying out there in the market about these 30-day expectations on these 30-day futures here and where rates could go?
Well, it ties back to our earlier conversation, the optimism, because I mean, in the prior months, and obviously with the data right in front of us, there wasn't any speculation about any rate cuts, based on their meetings and everything that happened. But the optimism and in different markets, the ability for things to pencil right now through underwriting, that shift, even if it's 25 and if it's 50 basis points, great. It'll help to get things underwritten, to get more deals done. And then the ripple effect from there, I mean, it could be vast. So, especially when you're looking at larger projects, 50 basis points is a night and day difference on the lending side. And especially when you're talking on the construction side too, for new developments. So yeah, it's all relative, but yeah, the ripple effect I think will be vast.
Absolutely. And Nathan, if we think about when this actually happens and how that's going to impact conversations with property owners, a lot of times property owners will say, well, I'm waiting for interest rates to come down so I can list my property to get more, right? I mean, we hear that on a regular basis.
I haven't heard that
yet. So we hear that on a regular basis. So that is no longer going to be an excuse for people to get off the sidelines. Yeah. So do you think when they do come out and say, yes, we're cutting 25, 50 basis points, there's just going to be a flood of new deals that enter into the market, or what's going to be the new excuse?
I think so. I mean, I think with Jerome Powell, I think the reason why he's not being very direct is because the market does react, the market reacts directly to what he says. So I think he's trying to leave things open to interpretation. But I think the guiding principles that I keep hearing is that rates are going to go down. I mean, I think everyone knows that. But I think when the rates do start to come down, there will definitely be a flood of inventory on the market, because a difference in, let's just say, 50 basis points, I mean, there's a huge difference in the amount of capital that you need to bring to the table and what you actually want your returns to be. So I think, I mean, like I said earlier, I think the ask big price is going to, I mean, that difference is going to get smaller, especially as these rates come down, because property owners, I don't think they're trying to budget much on what they want to sell their properties for. But if buyers are willing to pay more because they can get higher returns when that interest rates or the cost of borrowing goes down, I think that's when activity will definitely start to increase.
Absolutely. And you guys did a good point of kind of counteracting my philosophy. I mean, 50 basis points, doesn't seem like a lot when it's been raised 350 basis points, right? But it is a substantial amount when deals are very marginally, priced, and it does make a big difference for that, as well as just the investor psychology around it. And this is an interesting fact. Blackstone, which is the world's largest commercial property owner, they said earlier this year that real estate values are reaching a bottom as inflation has slowed and the Federal Reserve is expected to cut rates this year. Now, this perspective from the private equity giant really gives an optimistic sign for the sector, that commercial real estate sector that's been hurting from deal transaction volumes and valuation. And the last 2 years, this is from Steven Schwartzman. If you haven't read his book, it's a phenomenal book. But Steven Schwartzman's book, he's the chairman and founder and CEO. He said the last 2 years, the campaign by the central bank has resulted in muted returns. And we'll look back at 2023 as a cyclical bottom for our firm. So if he's calling the bottom currently, they are putting their money where their mouth is because they have been making some really big bets. Is this driving transactions or conversations with property owners? Because if they think the bottom is here and prices are going to go up, then they're going to wait until they go up, right? But on the flip side, we talk with a lot of people who are looking to do 1031 exchanges, and if prices are going to go up and you have to find a replacement property or pay a lot of capital gains tax, and that can be really hurtful for a lot of people. They don't like to do that. Then wouldn't it make sense to potentially transact now and not wait for prices to continue to increase, because you could end up negating the gains that you had because you're overpaying or you're paying a higher price on the other property. Nathan, do you have thoughts on that? And anybody else have any thoughts on Jon Gray with Blackstone calling the bottom of the commercial real estate market?
Yeah. I mean, like you just said, I mean, right now is definitely a good time to sell because you're going to have a lot less competition once you decide to sell, and you do need a 1031 exchange into another property. I mean, the reality is when the interest rates come down, I mean, more people will be able to hit the returns that they've required for the past couple of years, which means you're going to have a lot more competition. In order to actually find those deals, I mean, you're going to have to find off-market opportunities if you don't want competition. But the way things move today, I mean, even if you were to find something off-market, I mean, the odds of you not competing is still kind of slim to none.
Yeah. Nick, what about you, man? What are the implications of the largest commercial real estate property owner in the world calling the bottom of the market?
Well, it's multifaceted in the fact that when you see things that happen with them, moves that they make, once again, and I keep saying this, the ripple effect and the adjustment that people are making literally on the fly based off of what they're doing. I mean, it's tough to not pay attention to it and not, I don't want to say fall into that mindset, but you definitely have to think if, the biggest private equity and basically in the world is making this change, what are we doing and why aren't we doing something similar? So it depends on the person and the day as far as their mindset, contrasting against them. But, I always correlate it to status quo. What does that cost you in the long run? Sitting idly by, if you can get the returns and marginalize things from a business owner perspective or from a property owner perspective, why wouldn't you entertain it? So at least be able to benchmark where things are now versus historical data over the past 6 months, year, 18 months, which that's not really a good testament. But if you take it back another 5 years where the rates were different and so on and so forth, is it compelling enough to change your mindset?
Yeah.
Down to.
I think that's right. And we posted earlier this week about the data on smaller investors sitting on the sidelines. And a lot of times, we have similar to the Google effect or the Amazon effect, being that if they take a move and move their headquarters somewhere, or they're opening new facilities somewhere, Panasonic drops a multi-billion-dollar facility somewhere, other people are going to take note of that. And I think that's the same here with Blackstone and KKR and some of these larger groups. I mean, they're paid, they're paying some of the best analysts with likely the best data because, they are their own data source, right? Because they don't have to necessarily rely on, economics or economists' forecasts. They get to forecast themselves with what's going on with their own portfolio. And so there's a lot of what I'll call, insider trading going on from an information perspective. Go ahead, Nathan.
Yeah, and I was going to say, I mean, to take a somewhat contrarian approach to this, I mean, John, the reality is, I mean, Blackstone is a publicly traded organization. So the reality is, like, he owes this to he's trying to have he's being very optimistic when it comes to how things are going to turn out. And he somewhat has to be because he has shareholders to account for. And really, it's not that they're not looking at things in the long-term perspective, but they're really just trying to get movement or activity going on in the next, I would say 12 to 36 months. Like they're looking somewhat short-term at some of these things because obviously the market is very dynamic and changes over time. So.
Well said. Our very own Nathan Roberts taking on Blackstone on the Kansas City commercial real estate market pulse. I absolutely love it and agree with a lot of what you just said. All right. A couple weeks ago, we talked about what the 2008 crash was like in the housing and how that led up to the 2008 crash in real estate. Here's part 2, which talks through the differences between 2024 and 2008, because a lot of times we'll have conversations with people saying, hey, are we headed for another real estate crash, right? If you read just the headlines, you'll see a lot of that. I mean, because high property prices and rising interest rates, they're causing deja vu for a lot of people. But this time, there have been stronger lending standards and there is increased homeowner equity, which paints a different picture. So here's a framework to try to understand the similarities and differences. And knowing why, the differences are here, this could be your key to navigating today's market wisely. So let's start with high property prices. Both then and now, home prices have surged rapidly. And that was fueled by low interest rates then and demand outpacing supply. But we could be nearing a breaking point. I always like to watch the residential market because it happens quick, right? You can get a house in 7, 10, 14 days, right? I mean, and it moves very quickly. And commercial real estate market does not move that way because there's just so many different facets involved in that. So prices are elevated, but what happens next could be different. And we had rising interest rates in both times, right? Interest rates have climbed again, but the impact might not be the same. In 2008, adjustable rate resets caught homeowners off guard. Today, fixed rate mortgages are more common. I think the statistic is something around 70 to 80% of people have a fixed rate mortgage below 6% right now in the single family home market. And affordability is an issue, right? But mass defaults are less likely. So the rising rates are obviously a concern, probably for different asset classes more than single family homes, but it's not at a panic level yet. There's a lot of talk around the looming debt that's coming due. But let's talk through the stronger lending standards, right? We have tighter regulations, which are a game changer. Dodd-Frank introduced post 2008 safeguards. Those risky subprime loans are far less common now, and lending practices are more responsible. And then we've got the homeowner equity. So more equity means more security. So homeowners today have substantial equity buffers. And so even if prices were to drop, which we have not seen any type of data to support that, widespread foreclosures could be unlikely. So equity is that cushion that softens the blow. The last thing would be just the market fundamentals. This time, the bubble isn't driven by risky financial products, right? I mean, supply and demand are more balanced. Inventory is low, and that is supporting these prices. Speculative buying is not necessarily the main driver, and market fundamentals are solid, which could prevent a crash. So wanted to give an update just on some similarities and some differences between what caused the 2008 real estate crash versus where we are currently right now. But Nick, what's your biggest concern about the current market? And do you see any similarities that we should be thinking about back in 2008? Because I know for a fact you were out and about in navigating those markets.
Yeah, it's obviously there's a lot of fail safes in place to where the catastrophic event won't happen again, but and without giving away what we're potentially getting into next, the market cycles and whatnot. But yeah, the uncertainty was vastly different because of the financial markets. But like I said, with all the fail safes that are in place now, do I think it will be the same thing? No, obviously, but as you said, with the equity value being higher than it was before, people were just over leveraged and they were buying houses that they really couldn't afford back then, which, without getting into all those same semantics, the equity piece now is vastly different. So it offsets that quite a bit. But,
yeah.
When you look at market cycles in the next 2 years, and like I said, I don't want to give away any further conversation, but a lot of parallels in the timing of it. So, yeah.
What about you, Nathan? What's your biggest concern about the current market right now?
I totally agree with what Nick said. When it comes to the 2008 crash, that was primarily because of mortgage-backed securities. Right now, a potential crash would be because of that spread difference with, interest rates that people had some years ago and what they will be once their term is actually up. Not necessarily with housing, but more on the commercial side. One thing that I talked about just a few weeks ago on our last podcast was just that I think you have to be somewhat like asset class agnostic when it comes to like looking at a potential crash. I think with retail and industrial, I mean, the fundamentals are there. With office, not so much, especially dealing with the vacancy in income and how that directly applies to what the value of that asset is or that property. So I think you really have to be looking at things on a asset basis in order to determine if a crash is going to happen and how significant a potential crash will be.
Yep. Well said. Well said, guys. A lot of differences. And I think that there's probably more risk in certain asset classes throughout commercial real estate than there is from a global real estate perspective right now. And I think talking through those market fundamentals definitely gives me some security in regards to what's going to happen next. But let's talk about that, right? One of our most favorite things to do is to decide where we are at in the 18-year real estate cycle. And here's my take right now. I do not think that real estate prices have bottomed for this cycle. Now, I'm not disagreeing with Jon Gray when he says that real estate prices have bottomed, because if you look at the Green Street Property Price Index, prices did bottom and they have started to increase across the five major food groups. But that is, like Nathan mentioned, kind of a short-term view, but they have capital they need to deploy, and they have shareholders, and they have to go make profits. But if we look at a more global perspective on the 18-year real estate cycle, I believe that we are in the late stages of this 18-year economic and land cycle, what's dubbed as this winner's curse. So with the amount of dry powder that's on the sidelines waiting to be deployed, that we're starting to see get deployed, and the sentiment around interest rates being cut, I foresee property prices increasing in the short term. I believe that in the latter part of 2026 or 2027, which would line up with Ray Dalio's views on the long-term debt cycle as well. So I want to make sure that that is put in here, because I posted about that earlier today on LinkedIn. We might begin to see a drop in prices in 2026 or 2027 that could last until 2029 or 2030. That's when I think the full bottom of the market is, in my opinion. And just to back this up a little bit more, I did a little bit more research that I'm going to present on in a couple of weeks. But since 1955, the Federal Reserve has voted to cut rates significantly, which would be consecutive rate cuts of 1% or more 17 times. Of those, 12 occurred during an economic downturn or crisis. The other 5 could be considered preventative measures, the Fed attempting to starve off a recession. So again, don't think that I'm disagreeing with Jon Gray in the short term, because I think that increases are likely to happen, and we might be at a bottom in 2023, 2024, because prices are increasing. But I want to keep it in a comprehensive view that this is what is called the winner's curse, and we have until 2026, 2027 before I think that prices may start to really drop. And so that is my current view of where we're at. And so if you're out there and you're thinking about selling a real estate project in the next year or two, this view would be that it might make sense to start really doing a hold, sale, refinance analysis, which we're going to talk about here shortly. But wanted to kind of give my current perspective, and Nathan and Nick, if you guys have any thoughts on this, feel free to chime in on the more global and comprehensive view of where we're at with the long-term debt cycle and the 18-year real estate cycle. And I've had so many conversations with investors that have been in the market for 25 or 30 years about this. And they say a couple things, which I'm going to touch on in the next slide, but that you cannot put an exact time on this. And I'll talk about why that is and give a little bit of a story. But to keep this perspective in where we're at comprehensively, I think is really important for property owners to know that right now could be a really good time to get your market or your property marketed for sale. Nathan, any thoughts on the 18-year real estate cycle here?
Yeah, I mean, this is somewhat of a concept that I learned about probably about, I would say 2 weeks ago when you brought it up. I haven't really looked that much into it, but I would say high level. Obviously, this is a real estate cycle that has been tracked back to, I think you said 1855, and there's data to support this type of cycle. Obviously, what you're saying, is it exactly going to be 18 years? Not necessarily. It's going to be I mean, there's going to be some sort of variation. It could be 16 years or it could be 20 years, but like averaging it out, it's around 18 years. So yeah, I mean, I think it's definitely going to drive conversations in what I guess advise clients on what they should possibly consider. Definitely going into 2025.
Absolutely, absolutely. And I wanted to share this story with a gentleman who's been investing for a long time. He said that a few years ago he was negotiating a 99-year ground lease development deal in Hawaii to build a hotel and over about 1,000 units of apartments. And he sent the CEO of that company, which is one of the largest in the States, his unfiltered underwriting model. And he said that he had never seen in his life a model with a recession baked in it every 12 years or so. So, and then he came on to say this. So unlike climate cycles, and he sent me a video about it, which are influenced by natural forces that are repetitive, economies are influenced by human beings. So less predictable in nature. And he said, I would think this cycle is already in motion, but too many things can influence the economy that human beings can control. Money printing, interest rates, politics, and on, right? We cannot control the climate, even though some egos would argue otherwise. So he thought that since he agreed with the 18-year kind of cycle, right? But there's a lot of human intervention going on in regards to these types of economies and too many things that are controlled by man. But this is a really cool clock that Property Share Economics has put together. And they would say that we're between kind of hour 13 and 14 here, which is when we're going to start to see the land boom, where the world's largest or tallest or widest building is developed, and the complaints about property taxes. Well, I did a little bit of research and found out that the tallest skyscraper has been presented to be built in Oklahoma City, if you guys can believe that. Oklahoma City. And I think that many people are talking about their property taxes. The next thing I will be watching is lavish government spending for public works. Well, what's going on right now is an election year and a lot of campaigning. That's a lot of spending of money. So very interesting where they're at on their real estate clock as well. So I think a couple things to keep in mind here, that the pendulum of cycles swings back and forth, but it is human beings who give it the push. And that is one thing to keep in mind, and why, if anybody is saying that they can exactly give you an exact date on when something is going to change, then you probably should be a little bit weary or skeptical of what they're saying. All right. So this is another component that we've been getting a lot of questions asked about, guys, is the reality of the Kamala Harris plan to tax unrealized capital gains. And I actually had an event last night where I got peppered with questions about this, and I'm thankful that we had this slide kind of put together. But the media and investors have been burning up the socials here recently after learning that the Kamala Harris's campaign has endorsed a tax on unrealized capital gains. But lots of what was shared was inaccurate, and Nathan brought this to my attention. A lot has been headline grabbing things. Reality check is this. This is only going to impact a small subset of America's wealthiest people, and most real estate investors are going to be spared. So you can see here that if it applies to individuals with at least $100 million in wealth who do not pay at least a 25% tax rate on their income, and that is inclusive of unrealized capital gains, and payments can be spread out over subsequent years. So look, there's two things to know here. Number one, Harris didn't release a new tax plan. Instead, this is just the campaign agreeing with a series of items in President Biden's last budget proposal, the most relevant of which were non-starters in Congress and did not become law. So I relay this very similar to what happens with the 1031 exchange a lot of times. Like, hey, we're going to take that 1031 exchange away, and it's not going to be you're not going to be able to do 1031 exchanges. That has happened for almost 90 years now and never has gotten passed. So that's number one. Number two is you need to actually go understand the facts. Okay, and the fact is that this is going to really impact the wealthiest of the wealthiest who do not pay at least 25% tax rate on their income. So I just wanted to put out some of the facts there in regards to this. And a lot of people have been asking us questions about this and the impact of how that might impact the commercial real estate market. I think that is, to be said. There's a lot of things that have to happen for this to go into effect, but these are the facts that have not been spread more commonly. Nathan, did you have any additional thoughts on this, or do any more research on this? Because I know you and I had a conversation about this.
Yeah. No, I didn't do any further research on it. I knew high level based on some initial research how this plan actually what the plan was for. But like I mentioned a couple weeks back, I keep seeing a lot of posts on social media, some big name players that even some people that I look up to that like are very highly knowledgeable about real estate in general, that are I would say it's somewhat fear baiting. They're trying to get people to vote more in favor of the politician that they're voting for, which is understandable. But I just say if you want them to vote in favor of your preferred politician, just come with all the facts. Don't try to say that, oh, this is going to affect the middle class that have $1 million in their IRA or their retirement plans, because it won't affect them directly.
Absolutely, guy. Yep, that makes a lot of sense. Nick, any additional thoughts here? I know I always bring you in on the political items to give your advice on.
Maybe that comes with age. Wisdom's supposed to be with that, I think. Yeah, I'm waiting for that. But no, it's to echo your comments. The agenda by certain people, like you said, Nathan, come out with it if you're opposing a candidate, as opposed to, there's a multitude of things that I've seen where they're trying to break it down to where individualized home sellers were going to be how it was going to basically upend the residential housing market, because if they had to pay an additional 20+% in tax. So it's all agenda based. So yeah. Talk to your accountant. They'll know when it passes, if and when it passes, as far as how that's going to affect you and all your investments. But yeah.
Absolutely. Always bringing the facts to you all, trying to stay very middle of the road and talk about commercial real estate, but politics and policies do impact investing. So it is important to know on both sides of that, but definitely be focused on the facts. All right. We were a little bit long-winded today, meaning I was a little bit long-winded today. We will not be getting into our hold sell analysis. We will hold this off for our next market pulse, but we have some great examples on going through a portfolio analysis of should you hold, should you sell, should you refinance, and how to unlock your return on equity for growth. So that will be coming in our next episode of the Kansas City Commercial Real Estate Market Pulse, which we will also be having a special guest with us live, Robert Meehan, who is a capital markets expert. And Nick and I will get to be playing golf with him on Saturday of this weekend, which we're very excited. But if there's anyone that I bring on to speak about what's going on in regards to the largest portion of your deal, which is the capital stack on the debt side, it's Rob Meehan, knowing what's going on in those markets. So we'll have him here next week, 2 weeks from today, speaking more about what's going on in the financing world, as well as going through our wholesale refinance analysis examples. A couple events that we've got coming up here. We have space here on our third annual Operation Breakthrough Together We Win golf tournament on Monday, September 23rd. So sponsorships are all spoken for, unless you can sweet talk Katie, but we do have a few extra teams that we could probably throw on there. We like to keep it moving fast, and we don't want you guys to be out there for 5, 6, 7 hours. And so we like to get done in 4.5 hours. So we keep it limited to about 25 to 28 teams. So we have a couple teams still ready to be spoken for, but it's a great day. It's going to be a wonderful day to play some golf, and sponsoring a great organization here in Kansas City, Operation Breakthrough. They will be there on site speaking through that. Additionally, we've got the Cash Flow Summit coming up on October 23rd to the 25th. I'll be there speaking about Kansas City. So please decide if you'd like to come and visit us in Kansas City on October 23rd to the 25th. It's at the Overland Park Convention Center. Lineup of speakers is great. It's going to be well attended, and it's going to be a really awesome event. So very excited about that, and all of the speakers that will be there. I have a lot of people coming in from out of town to speak and to attend the Cash Flow Summit. So definitely, if you can make it to Kansas City, reach out to us and we'll get you hooked up with some tickets for that. Additionally, we've got our multifamily meetup groups starting back up this month in 21 days. We've got our regular programming on our multifamily meetup group at String Hall in Old Overland Park, downtown. Such a cool area, great venue, always well attended. There's October's and January's events there as well. All right, if you are interested in anything that we spoke about today, right, we've talked about a lot. We talked about what the impact of the Federal Reserve meeting here in 14 days is going to be, how that can impact your decisions moving forward in regards to investing or selling your real estate. Jump over to our website at exchangecre.com or follow Nick, myself, or Nathan on LinkedIn. Shoot us a note. We're easy to get a hold of and in contact with. We're having conversations with investors and property owners every single day. And I am excited to speak with you all. Thank you again for joining our 5th episode of the Kansas City Commercial Real Estate Market Pulse. Nick, Nathan, any parting words for our listeners today?
No, you covered it all, man. Thank you.
Well, thank you guys for joining and being here. We'll see you in 2 weeks. Right on the cusp of the Federal Reserve meeting. It's going to be a fun one. We'll have a capital markets expert here for us to talk to and help navigate the rest of this transaction wave that is coming in 2024. So thank you guys again for joining. We'll talk to you next time.
See you guys.
See you.